Hello, everyone. My name is Randa Safah, and I'm going to do today a webinar on how to be investor ready. My experience has always been behind the scenes. I'm the person who pays the investors like VC funds, accelerators, incubators to invest in in startups. So I sit also on an investment committee and observe a lot of pitches. I also had the privilege to work with startups on an informal basis. Some come to me for advice, and I enjoy the dynamics. I can also call myself a small nascent angel investor because I recently invested in 2 startups in 2 verticals that I'm passionate about. It's in digital marketing and logistics, so both are in the services sector. So this is why I came up with the idea of doing this webinar. So this webinar includes best practice and textbook information, but it's also my view on things. So this is why I structured this webinar in a way to answer the following questions. What are the investment challenges that a startup faces when seeking investments? The type of investors out there, the types of funding, what investors look for in a startup, what investors look for in founders, how to approach investors, how much investments you should ask for, how much equity you should offer, and what are the common mistakes to avoid, what questions you ask yourself, how to prepare your pitch, and some founders' advice. What happens after investment, I skipped it. I'll talk about it without the presentation. All these elements will allow you to know if seeking funding is the right choice for you and your startup, the how, the when, and the why. Seeking investment looks to me like a stairway that allows the founder to walk up or down comfortably. A founder has to either walk up the stairs or choose the steps to take depending on the investment stage. These steps should not necessarily be climbed in this order. A founder may be selected in an accelerator. Another founder may attract the attention of a VC even at an idea stage. There is no specific rule. This is why it's important to be informed on the funding options. Because when you are not informed, you will go all over the place, approach different investment channels without being ready for the specific channel you choose, and you may reach nowhere and maybe miss your chance. So first, let's understand what are the different types of investors. First, you have friends and family. Friends and family will invest in the idea and will invest in you, because at this stage, there is little evidence and proof of real investment. Government agencies. There may be government programs that provide grants for certain types of projects. Watch out for them and also watch out for restrictions and limitations. Angel investors. These are professional investors willing to take a high risk, flexible in the terms that they will sign with you, and they can provide value, added advice, and connections. You have also angel groups. It's a group of angel investors willing to provide a collective investment so their risk is spread with less or more diversified risk exposure than a single angel investor. You also have accelerators and incubators. If you are accepted in an accelerator program, you may receive between $10,000 or $120,000 in seed money. It's not all in cash, it could be in kind, to develop your idea and gain traction. An incubator is a space you lease and you are provided with it with an administrative support, access to partners for general business services and funding. These vehicles can be a good trampoline to other investors because they will develop your network and will assist you in finding investors to follow-up rounds. Then you have the VCs. VCs represents the bigger checks, but they are more likely to invest in Series A, B, and C. We will see what that means if some of you don't know, fundraising rounds. All these firms are structured the same way, but you may find VCs specialized or have preference to certain verticals. You may have VCs that have interest in certain industries. So not all, you have to, we'll see later what you have to do to approach them. You also have family offices. If they are interested and if their interests are aligned with the startup, family offices can be a good option, provided that the startup is ready for an early exit. You also have corporate investors. These are corporations that are interested to invest in startups because they allow investments in diversified assets. They can identify talent and technology which can help them to be at the forefront of their industry. Many create their own accelerators and incubators. So you would have corporate investors that would have these accelerators and incubators, and you have to watch out for them. In all cases, it's important to research your investor well before presenting your idea and pitching. Startups can benefit from securing funding from a non-traditional source and prevents the startup from giving equity early on. So there are alternatives to investments. Here are some ideas of non-traditional funding that doesn't require giving up equity. You have crowdfunding. Crowdfunding is a way to raise money from a large number of people. Large groups of people pull together small individual investments to provide the capital needed to get a company or project off to the ground. Individuals, charities, or companies can create a campaign for specific causes and anyone can contribute. It doesn't have to be an investment. It can be a pre-sale campaign for the product. You can gather enough funds to create the first prototype to consumers willing to pay for it and try it. Crowdfunding platforms are not free, however. You have partners financing. It's a strategic partners financing where another player in your industry funds the growth in exchange for special access to your product or staff or distribution rights or ultimate sale or some combination of those. Factoring, with the strategic partners, with strategic partner financing, another player in your industry funds the growth in exchange for special access to your product, staff, distribution rights. And then you have the merchant cash advance. The merchant cash advance is the opposite of a small business loan in terms of affordability and structure. While this is a quick way to obtain capital, cash advances from your merchants could be an option, but sometimes it's a bit expensive. So investor types and typical funding rounds. So it depends on your stage of investments. You would find different types of investors that we've talked about before. So if you are at the idea level and you are in a pre-seed stage, you can either finance it yourself, it's with friends and family, or pitching events and hackathons. When you are at the validation stage, which is the seed stage, you can be with incubators, government agencies, angel investors, crowdfunding. So you see, for angel investors, you need at least the idea to be validated. For early traction, VCs, so it's a Series A, VCs, VC capital firm, venture capital firms, venture debt firms, other debt institutions can invest with you or lend you money. Scaling, so Series B, C, D, whatever, it goes on and on. It's for venture capital firms, investment firms, private equity funds. And then once you've reached a point where you have to exit, it could be, you can be buying back your own shares. You can sell a share. You can do an IPO. You can list yourself on a stock exchange, or you can merge or be acquired by a bigger player. And so these are the typical funding rounds. So what do investors look for in a startup? They look for a lot of things, but I tried to really summarize them in these 8 points. They want a solid business plan. They look for an industry they are familiar with. They looked for a product market fit, a unique value proposition, a strong leadership team, traction, an idea that creates cash flow or value, and a clear exit strategy, meaning that they can see how they will be able to exit your investment and make money out of it. So what do investors look for in a founder? Well, they look for certain skills and traits. The skills include leadership, networking, communication, time management. I put bold on that. Team management, strategic planning, originality, and how to source skills that they don't have. The traits they look for is they want a persistent founder that is not afraid of failing. They want somebody who has a sense of initiative, determined, a planner, goes back to time management, risk taker, can deal with the worst, imaginative, a constant learner, his own best storyteller, and somebody who accepts failure. But then with all those, you also have to look at yourself, find what you are unique at. This diagram is an adaptation of the Ikigai Japanese philosophy that talks about the meaning of life. So let's say you have all the skills and traits an investor searches for. But did you ask yourself the simple question of what is your purpose? It is a simple question, but not really so simple. You need to make sure you know what is your purpose and what you are unique at. You will succeed when you find your purpose. Look at this diagram. So if you do what you love and what you're good at, it's passion. If you do what you love and what you can contribute to the world, it's contentment. If you do what you're good at and how you contribute to the world, it's your career. But if you combine all those three, it's your startup, it's your dream. So this is possible when what you love and what you're good at is done for the service of others. So how to prepare for whenever you want to approach an investor? First, you have to prepare your mindset. Everything is about mindset. You have to be prepared for rejection. And please consider rejection as a learning experience. Take the advice and build on it. Even if you are still not ready for an investor, prepare your business plan and your pitch deck. This is a great exercise to master, and you have to do it on and on and on, which we will cover in detail later on. Again, research your investor. See what he is interested in. What are the verticals he covers? What are his requirements? You will find all those on their websites and on their social media. The other thing, you have to always be networking. Networking will make you visible. And the best thing you can do is ask for advice. You never know when advice becomes money. So when you are introduced, you may opt immediately to present your pitch, but I prefer that you have an informal meeting first with a chat. It all depends on the dynamics and the investor you are approaching, and of course, of the stage of your investment. So at the time of contact, make sure you break the ice by getting to know your investor. Sell your method, not your product. Remember, the investor is looking at who they will partner with. Present your company and product with passion, but please be concise. Ask questions to build trust. Don't forget to check in for a second meeting. Patricia, I will cover all the questions at the end, if you don't mind. So these are some tips on how to approach investors. First, as I said, and I'm saying it over and over again, research the person and the group you are approaching. Look at what investment criteria they have. What if they are active or passive investors? What are their achievements? Second, you should network. Participate in networking events, draw your professional presence online, make the right connections online and offline. Get introduced, outline the problem, have a solid business plan and action plan. You should also have a great team. A co-founder is a great plus if you are alone, at least 2 people on board, and cover the gap with multi-expertise advisors. Be prepared with outlining the problem and your action plan. Show your understanding through a pitch that is simple, catchy, and professional. Be realistic, avoid inaccurate information, keep your credibility, establish a healthy and trustful relationship. Keep it simple, focus on facts, try to relate by giving a personal real-life example of the problem. Provide an exit strategy, shows an understanding of your company, shows the investor what's in it for them. In the end, it's about value, not only passion. And finally, how to ask. Do not ask for money, ask for advice, and the money will come. Now, I put 2 slides to show the difference between what are the prerequisites of an angel to invest with you and the VC. So this one is about, it's the same, if it's the same categories, but the dynamics or the details are different for an angel than for a venture capital firm. So angel investors understand that by investing that early in the game, there is a high risk of failure. For that reason, angel investors review certain important issues that play a major role in their decision to invest with you. So angel investors look for a founder that they know or have been introduced to, that is passionate and in it for the long run, a founder that has identified a team that works well together. They also ask themselves about, the angel investors ask the following questions about the founder. What relevant domain experience does the founder and the team have? What key additions to the team are needed in the short term? Why is the team uniquely capable to execute the business plan? What motivates the founder? How do you plan to scale the team in the next 12 months? In essence, the angel investor will have to do a judgment because there are not enough key metrics to back up his decision. So mostly it's about the founder. Also, the angel, when they look at the product, they look if there is traction or there is a beta version or a minimally viable product. They also look at an initial or pilot customers, especially brand name customers. They look at strategic partnerships that the founder has done. They look at customer testimonials, admissions into competitive programs, how differentiated is the company's technology, what competitive advantage will there be over existing technology, how easy will it be to replicate the technology, and how costly will it be to build the technology into each product. They also look at the market, but they look at if it has a big opportunity, if it's scalable, and if it will become meaningful. The angel would want to know if you understand the addressable market you plan to capture the market share from. The angel also looks at the competition. The angel would want to know if the founder understands the competitive landscape. Make sure you have a research the competition and anticipate the question you may get about the competitors. The angel investor would also want to see a business model that shows that the founder has identified all the potential risks. The angel investor would definitely want to see a professional pitch and a small, well-presented business plan that shows the understanding of the founder and the startup's business model. Also, the angel investor would want to see a financial model that is believable and interesting. But after talking about all this, there are three major things that the angel investor looks for: an exceptional founder, an appealing idea, and an exceptional presentation. Now let's look at the prerequisites for a VC fund to invest with you. And reaching out to VCs is a serious commitment. So you need to know when is the right time to approach them and how to approach them. A warm introduction is a plus, of course. Both angel and VCs look at the same verticals, but their request for each vertical is different. A VC looks for a team that has a previous relevant experience. So already the VC wants the founder to have relevant experience. At the angel level, they just want to see somebody who has passion and who has an idea, and they want to develop it with them. A VC, they look at a team or a founder that have previous entrepreneurship experience, a team with complementary skills, like they don't want to see just one founder, but a full team. They have business development, they have IT, they have other skills. They want to know that their team has business degrees or knowledge. They are motivated, dynamic, and self-driven. They are creative and lean. The VC looks for a product that has a competitive edge, existing solutions in the market, so already difficult to duplicate, that has an IP, disruptive versus incremental, market traction through a pilot or a beta version. The VC looks for a market that is a nascent market, sizable market, easily scalable geographically, focused on high growth, niche segments, and clear growth drivers and available market intelligence. The VC looks at a competition that has a company that has little or no competition or clear competitive advantage, high entry barriers, first mover advantage, big players that might be slower to respond, so very high barriers to entry. A VC also want to see financials that show high margins, lean or low capex for easy scalability, low fixed costs, fast growth in the first 5 to 7 years, and favorable users' economics. More importantly, the likelihood to nail funding from a VC are three main variables. Your product and service has a sizable market with high growth. Your product or service is easily scalable geographically, and your financials show a fast growth in the first 5 to 7 years. So, how to find your ideal investor? If you are an entrepreneur and you have bootstrapped means that you have invested your own money and you have strapped yourself to the maximum. So you have bootstrapped enough to build your business model with enough traction. It is time now to find your ideal investor and the idea match in every stage. So how do you know it is the right investor for you? First, you have to understand the business opportunity you are facing. Second, you have to know the capital you need to raise. This is surely not enough. So after you have done your research, make sure that the culture of the investor fits yours. The investor and the founder have to have chemistry with each other. Integrity and honesty are key to build trust. More importantly, the investor you choose should have a network for future investments and or exits. So now it's no longer about what you research about the investor, it's about how you want your investor and how you can match that together. So you should also be able to look up to that investor or investment firm. You should also be able to learn from your investor or investment firm and give you the time and the commitment to do so. So it's not enough for you to look up to your investor. It's important that your investor gives you the time also, so that the founder can, or the company can, learn from him. Now, how much investments you should ask for? Generally, when you seek investment, you ask yourself 3 questions. These questions are mathematically interrelated. So the first question is, how much money should I raise? What percentage of the company should I sell? And then what company valuation should I use? You can do financial models, use metrics, use market data. All these are important to translate your vision into numbers. But when it comes to how much investment you should ask for, it comes down to 2 ways. These 2 ways are, the first one is to decide how much investment you should ask for. And the second is to start with how much of your company you want to sell. So let's start with the first option. How much investment should you ask for? Please don't have the mindset of, I want to raise as much as I can and then we will see. Don't do that. A good rule of thumb would be to calculate the funds that you need for the next 12 to 18 months. But to do so, you have to start fundraising 6 months before that. These funds should cover, so we said you have to start 6 months before to fundraise for the next 12 to 18 months. It's called a runway. What should these funds cover? How much you have expenses, monthly burn rate. You should add that the salary of the people you want to hire, because you need the funds to expand. You might need to account for the marketing expenses you need, and you need to account for also the development cost or cost of developer that you will hire. The amount you reach should be multiplied by 12 to 18, and this would be your ask. This is the amount you should include in your pitch, but be careful. When asked about the amount, do not say that this is to cover my burn rate, my hiring people, etc. No, you have to show that this amount will allow you to reach your milestones and KPIs and at the timeline you are determining. Do not present your ask as if it is for your survival, even if it is. One of the most ridiculous answers that I received once from somebody who was pitching to get an investor is that I asked them a very simple question. I told them, do you work well as a team? And the answer was, give us money to rent an office and see if we can function as a team. So that's really a no answer. The second option is to decide how much percentage you are willing to sell. When founders ask me, I usually tell them that the rule of thumb is not to give up more than 20. And the lower percentage you can give up, the better. If an investor is asking for more, rethink how you are valuing your business. So, at what valuation? Determine the value of your startup in early stage comes down to supply and demand. How many investors are interested in your startup and how much you are willing to give up at what value. This is why it's interesting sometimes to relocate in a different market where there is a big demand for your idea. These are some of the ways you would value your startup. First, you can pitch a number and justify the valuation based on your product vision and your ability and your team's ability and deliver it. So if you can get away with that, that's amazing. But you can be more scientific by using a qualitative approach or a quantitative approach, or a combination of both. The qualitative approach that would include the demand for your product, the size of recent exits of similar products, the willingness of an investor to pay a premium to get into the deal, and the level of desperation of the entrepreneur to get the money. The quantitative approach, you can use market multiples of your nearest competitor and adjust it depending on your investment stage. Or you can take the expected revenues and multiply it by the price to sale multiplier of your nearest competitor. So let's say you have expected sales for the next year of X, and you know that the value of your nearest competitor has a price to sales of 10 times. So you multiply that by 10. Here you have the value of your company. So what are the common mistakes to avoid? The first one, there's a lot of mistakes, but I gathered 20 mistakes. Do not be afraid to fail. Do not be disorganized. Register your company. Don't keep your company unregistered. An investor does not like to see an idea from a company that is not registered. It shows non-commitment on the behalf of the founder. Do not be a one-man show. Choose your investors wisely. Sign your verbal agreements. So whatever you agree with anybody, sign it, put it on paper. Look at investor requirements well. Spend only according to KPIs. So you cannot spend without having listed your KPIs first. Pay yourself wisely. Plan, plan, plan. Don't launch too quickly. Don't expand too quickly. This is where, and then you ask yourself, so how can I do that? Well, that's why you get advisors. You surround yourself with a good board of advisors of different specialties. And people are really willing to do that for free because it's their way of giving back. Make sure you have proper bookkeeping. Don't hire the wrong people, and don't be afraid to change your team. Some would advise, no, don't change your team, etc. No, don't be afraid to change it if you need to. Don't overpromise or underdeliver. Be honest with you, with your team, and with yourself. Be honest with your investors. Do not ignore constructive feedback. Finally, know yourself. Questions you should ask yourself. How am I serving others? So it is really about serving others. So is your product or your company is about, or service is about really serving others? Why am I doing what I'm doing? So keep asking yourself this question, because this will remind you, you will always remind yourself why you're doing this, because you will pass through ups and downs, especially downs. And when you ask yourself this question, you will remember why you went into this startup in the first place. Also be honest with yourself. So ask yourself, what is my alternative path? Am I ready for the sacrifice? What am I changing in this world? What if it does not work? So what? You can change your path. You can make it work. Are my personal and business goals aligned? Are my personal and business goals aligned? So here we start talking about how to pitch for investors. So before we look at the pitch deck, how it looks like, there are a lot of do's and don'ts. These, I believe, are crucial ones and will help you pitch better. Investors have to listen to hundreds of pitches from entrepreneurs. This is why your pitch has to follow the 30-20-10 rule. 30 seconds to state your objective, 20 minutes to finish your presentation, and 10 slides to tell your story. Or as Guy Kawasaki, who is the ambassador or the evangelist of Canva, he repackaged this rule and said 10 slides last no more than 20 minutes, and contain no font smaller than 30 points. My font is smaller, it's okay. Those 10 slides should contain mainly problem, your solution, your business model, the underlying magic of technology, marketing and sales, competition, team, projection, and milestones, status, and timeline. Here are some others do's and don'ts. So you have to know your audience. You have to know how to captivate attention. You have to present one idea, one story, one problem. And you have to talk about your competitors. Do not be a know-it-all, and don't oversell, and do not be obstinate, and do not overstate your numbers. So when I thought about what would be the best pitch deck to present to you, I like this one. It's a pitch canvas. Why? Because you see everything in front of you. You can print it on an A3 paper and put some post-its and put it on your wall and put post-its on it and write each one, so you can write your pitch deck, okay? And then you can put it in 10 slides. So what should be in the pitch, and how should you pitch? So I chose this pitch canvas by David Beckett because it's a brainstorming tool to help entrepreneurs think through their pitch to investors, partners, and customers. David Beckett has developed it through hundreds of conversations with investors and pitch competition juries. So we're not trying to reinvent the wheel, okay? As well as by coaching over 950 startups around the world. And I thought it would be a great tool to organize your ideas and your plan and help you prepare your 10 pitch slides. So as you see, there are 10 major parts to cover. But first, you should start with a simple statement of what change you and your product are making in the world. A memorable one-sentence explanation of what you do for your customers. This is the 30 seconds to state your objective that we talked about in the 30-20-10 rule. The 10 slides to cover are the problem, which is the pain, the product, which is the solution, the product demo. We're going to go over them more in detail later. Your unique value proposition, your customer traction, your business model, your investment, your ask, as we talked before, your team, the call to action, and finally, why you? Because in the end, it is all about you. Investors are investing in you, your idea, your background, and what you stand for. So your introductory statement should be interesting, memorable, and succinct, which means little, small. It also needs to explain what makes you or your organization, product, or idea unique. When you start your presentation with a problem rather than a thought solution, it is a more efficient strategy to retain your audience and make them believe your idea. The problem should show that your company's objectives are aligned with the problem you are solving. So make sure your pain points are clearly stated. A lot of great ideas do not get the opportunity because they do not know how to present it in a clear and appealing way. So what should you include in that slide? You should include what is your problem and how big it is. Why is it important? Who are you solving the problem for? Can you make it human so everyone relates to it? Can you explain it to five-year-old? Have you validated it that people will pay to solve it? So once you've determined your problem, so if you successfully worked your way through the first slide of your pitch deck, you and the investors should have agreed upon the fact that there is a huge problem you are willing to solve. This is a good start. Now is the time to show how you will solve this problem. Always try to present your solution most realistically and innovatively. And because the investor is investing in you, not only your product, then show them more of your ability to solve that problem. Take the investors on a journey of how you found the solution, and it is a nice way to demonstrate your thinking pattern and to build additional trust. So what should you include in this slide? You should say, how does it work? What does your product do for customers? What can your customers do as a result of your product? And why it is better than other solutions. So once you have shown your solution, so if you have a physical product, bring it. Investors love to touch and play with it. If you have a digital product, show demos, mock-ups, illustrations, or videos of it. You want to impress the investors with everything you've got so far, but also the things you will add in the future. So for some products, it's also a good idea to develop a story that demonstrates how your product delights the life of your future customers. Aside from the live demo, if possible, you can consider having a screen flow movie of a working app or screenshots, a customer using it, and key IPs like patent pending, copyrights, domain name, etc. Now we've done the initial statement, the problem, the solution, and the product demo. Now it's interesting to do a slide on your unique value proposition. A value proposition is a promise of value to be delivered. It's the primary reason a prospect should buy from you. It's also the #1 reason of capturing the investor's interest. In a nutshell, a value proposition is a clear statement that offers 3 things. Relevancy, explain how your product solves customers' problem and improves their situation. Quantified value, deliver specific benefits. And differentiation, tell the ideal customers why they should buy from you and not from the competition. So try to answer the following questions when writing your unique value proposition. How do you help your customer get results differently? What is new and innovative? Show you have researched the market and know your competition. After you've talked about value proposition, it's very important to show your investor that there is traction. The traction slide of a pitch deck should present information about how your product or service is already showing its value. This can include current sales, growth, valuable partnership, endorsements, pre-orders, or data from a pilot study outlining current customer interests. So if you don't have a product, at least you can show a study of people's interests in, let's say, your designs or your product, etc. So what if I am a startup and I don't have traction? You can use 3 metrics. You can collect pre-orders for your product and show it. You can show you have a large user base, and you can show that your users are engaged. As a small advice, check what could be your metrics and start measuring them on a regular basis. This will help you not only build your traction slide, but most importantly, build your KPIs and follow through on them. So what should be in this slide? You should ask yourself, what early traction has the company gotten? Sales, traffic to the company website, app downloads, growth metrics, etc. Customer testimonials and competition wins. So make sure you go into these competitions. If you are a startup, it's good. It gives you exposure, and it's good to be part of these. So once you've talked about your traction, now is the important part, is to talk about your business model. This slide is a zoom out of your business model. Keep in mind that the primary function of your business model slide is to show the investor how you make money. So it's not only about the number of users, it's about how you are monetizing your business. Unless it's a freemium model, that's a different story. I also advise you to build your business model canvas. If you haven't done so, it will help a lot. So in this slide, we would include how do you make money, what is the pricing model, and what is the long-term value of a customer, and what are the customer acquisition channels and costs. No investor will give you money if he or she has to guess how much to give you. A pitch deck without the ask will land you nowhere. You need to show your investors that you have put a skin in the game by investing yourself. So be transparent about how much you raised so far as well. But most importantly, show your investor how much money you are raising now. What will this money generate and where it will be used? As previously said, don't tell them I'm taking the money to pay salaries. Tell them you are taking the money to reach certain goal in a certain timeline. Include in the slide the type of investor you are looking for and what you are expecting from him or her, and don't show them you are desperate. It is common to give a short bio for each of your key team members, including education, relevant experience, and any accomplishment. Always ask yourself, what precious or previous things in your team's member lives could be helpful for your business challenge? So in your pitch slide about the team, show your core team members, have professionally taken pictures, show the people's names and their job titles, display short bios, and you can probably put a quote for each member can put a quote that they live by. Because in the end, investors are investing in people that have a great idea and are capable of developing it. Finish strongly. Go back to your opening anecdote or idea, or end with a challenge, or invite your audience on a metaphorical mission. Use repetition for a dramatic close or offer inspiration, surface their objections, tell a story, ask an unusual question, end with a quote. So choose any one of those or any 2 or 3 of those. And the last slide, why you? In pitching, you are showing that you are putting yourself out there. So why not go all in? Dedicate a slide about why you. Be confident about it. Of course, the why you statement should show up in any part of the pitch. In this slide, just say as well, why do you care about solving this problem for your customers? How has your life been affected by this industry? Why should your audience have confidence that you are driven to do what you promise no matter what? So this is for the pitch deck. So what I would like to talk about is, I would like to finish with some advice I read online and that I liked and that that you can take with you today. The first one is get out of your comfort zone. Become savvier about numbers. So you have to know how to build a financial model and what numbers do. You have to know the importance of trial and error. So it's okay to try and it doesn't work, then you try again and again. How to grow a company culture. It's very important to have strong company culture. Teaching people how to be great leaders. So always make sure you put your team out there for continuous training. There's a lot of free training out there. Balancing short and long-term goals, staying informed on latest in the social media, how to grow your company culture, be a better communicator, excel at hiring and building a team, scale your company sensibly, provide nuance, feedback, and advice, finding a better work-life balance, trusting that who you hire will do the job you need. Build a space conducive of ideas. It's very important to always listen to your team and make sure they always come up with new ideas. I once went into the headquarters of Anghami. There are no desks there. They're all on couches or on the floor. It's a very artistic place and they feel at home. They do whatever they want just to be creative. Take customer feedback into account. Hold on to values as you grow. So don't forget your core values. When you do your small business plan, the most important thing for me is to remember your core values and don't forget about them. Understand that you achieve big goals takes time, so you have to understand that. How to put the needs of others before yours is also important. How to build a company that inspires the change. Always remember why you're doing what you're doing. How to make products that appeal all over the world. How to get inside the mind of the customer. Time management in the face of rapid growth. It's not easy to manage your time when you want to be all over the place. So plan, organize, and have time management. Be honest with yourself about your strength and weakness. Find a solid mentor to coach you. It's very important. They push you, they coach you, they are there with you, they hold your hand. The brands that win are those that tell a great story. So you're not selling a product, you're selling a story. Great things in business are never done by one person. They're done by a team of people. So there is also a part that I didn't cover, what happens after you get investment. So whenever you're going to an investor, you have to have a pitch deck, you have to have a one-pager sometimes, and a small business plan. But let's say they gave you money, there's going to be a term sheet. So the term sheet, it's very important to first make sure that this is the investor that suits your culture, but then there are terms, a lot of terms that you have to be aware, and don't sign on anything you do not understand. So that's my final advice. And now, are you ready to ride the wave? Thank you. So any questions? I'm done. Okay. So anyone has questions? Yes. Aya?
Yeah. Thank you very much. I'm Daniel from Ethiopia.
Hi, Daniel.
Yes, wonderful presentation.
Thank you.
I just have been concerned about finding the investor in the East African area, like in our country, like the access to the investors, like the access to the angel investors is not that easy. Can you give us some advice on those regards, how to reach our innovative business ideas to those? Thank you.
Well, as I said, you should research the ecosystem in your area and make sure that I don't know about a little bit the market there, but if you want, I can help you research, because I know a few funds in these areas. And I can also help introduce you to them, but I would like to know more about your product and your space to see if they are a right fit for you. But usually you have to, as I said, you have to research your investor base, look at what VC, and what stage of investment are you? Are you at the idea stage?
Yes, it's on the idea stage.
It's an idea stage. So when you are at an idea stage, you have to look at accelerators and incubators in your area, because this is where is your best bet. But as I said, you should start with your family and friends and yourself. But if you don't have that, you can always look at accelerators in your area. So this is your best bet, actually.
Yes, thank you very much.
For sure. Who asked for a template for the pitch? Okay. Thanks, Michael. So my challenge is in having a compelling pitch. Is there a template? There's a lot of templates online, but the template that I showed you is really very helpful. So I can share that template. I downloaded it for free online. If you want, I can do that. And I would be happy if you want to have a one-on-one. We can discuss the advantages, disadvantages of what pitch to choose depending on the idea or product that you are presenting. Okay, so how can we identify and find investors that are a good fit for us? First, well, if you have a problem with that because I've explained all that, if you have a problem with that, I believe you should find yourself a mentor or an advisor that you will be able to talk to, and they can help you identify that investor. But mostly you have to have chemistry. They have to understand, you have to see that these investors have already invested in the same industry that you are in. And mostly it depends also on the stage of investment you are. And yes, okay. So thanks for, will you share this video also? I would like to watch it over again. So I don't know, Elvira, will you, it's gonna be on YouTube. Okay, so I said sell a max of 20%. I'm saying it's a rule of thumb, okay? If an investor wants more as a condition to invest, well, you have to see how desperate you are, okay? And also you have to see if you are properly valuing your business. Maybe you are undervaluing your business and that's why they want more. It really, really depends. I said it's just a rule of thumb. I didn't talk about the current ecosystem in Lebanon because it was open. The current, I can talk about it now. The ecosystem in Lebanon is not doing well. There was a total of 12 funds, VC funds, that are investing at different stages of the investment space. And you had accelerators, there are still incubators. I researched lately who would be willing to invest for Lebanese, and I saw that there are 4 funds. I would be happy to share with whoever is interested, who is really investing still in Lebanon. So yeah, but there's not a lot. I really digged hard and I called every single one of them to make sure if they are providing capital or not. Your best bet is to check with funding outside Lebanon in the region. And that too I can help with if anybody's interested. Okay, Caroline, can you drop a message to Elvira or send me an email? I will put my email here if anybody's interested to talk to me. Okay. Anyone? Dr. Mazen, do you have a question?
Yes, hi, Randa. First of all, congratulations on a beautiful presentation. Very informative.
Thank you.
I actually have 2 questions, if I may.
Yeah.
The first question is, what is the most dangerous question that an investor could ask a potential seeker? And what is the deadliest answer that seeker would give? That's the first question. The second question is, to you in your experience, what are the first or the first 2 most dangerous deal breakers when you're negotiating with your investor?
Okay, so so the first question is, what is the worst question that they can ask and you don't have the answer? Well, for me, the worst question they can ask, if they ask you how much money you want and you don't know, okay, that's the worst question. Because if you don't know, then you don't know your business model, you don't know how much you're spending, you're not organized enough, and you're not capable of coming up with a number. For me, that's the deadliest, because you would have presented, and you've reached the ask slide, and then at the end, you haven't even put that slide, and I've seen that, and that's really deadly. The other one is, what are deal breakers? Well, as Michael was saying, if I give 20% and if they want more, the problem is that when you are so desperate because you have not organized yourself enough ahead of time. Let's say when I said, well, you need 6 months to prepare, because let's say you cannot wake up in the morning, say I want money, and then you get it in the next month. You need to prepare yourself 6 months, and in these current crises, probably a year ahead. So when you're so desperate, for example, that's why it's important to know first at what stage of investment. But let's say you have a VC that wants to invest with you. They want a seat on the board. They want voting powers. So it's all about how much are they really, or do you feel that they are squeezing you and not letting you breathe concerning they're not giving you enough leeway. Are you comfortable about that? If you're comfortable, it's okay. But if you're not comfortable, it will kill your company and will kill your investment. So basically, it's important that your priorities are aligned with your investors. So whatever they are. So let's say they want to have 3 board seats and you have total of 5, and in whatever decision you cannot take it on your own, and this is something you don't want, and so then that's a deal, that's something that is not acceptable. So you can always deal with the money part, with the percentage part, but when it comes to decision making, I think it's the hardest part. That's why you have to have chemistry, and you have to have an understanding and a clear agreement, and a signed one.
Thank you very much. I believe what you just answered, I mean, that opens the way for a session specialized for that, negotiations, and that's quite interesting.
Yeah.
Thank you, Randa.
Sure. Emily?
Yes, hi. Thank you, Randa.
Sure.
The presentation was great.
Thank you.
My question is actually related a little bit with what Dr. Mazen was asking, but I wanted to know if I am pitching for investors and I have investors on board, it's like I'm not looking for a partner. I want an investor that will join my company, like help me with the capital, and then they will exit the company. Is there any terms or conditions that I have to follow?
There is a royalty program, and this royalty program is but it's restrictive for you, because let's say you agree with that investor that he will give you that amount of money, and that based on a business plan and a financial projection, you will return this capital for him over, let's say, 5, 6, 7 years with a specific return that you will both agree upon. So it's like some sort of a convertible, but it's called a royalty program. We can talk about it more when I see you.
Yes, great. Thank you.
Sure. Somebody said, I have 2 friends who invested in my company and we all have equal shares, but now they are with me and don't contribute to the company. How can such an investor be approached if you want to get rid of them? You can't that's the problem with investment in shares. You cannot get rid of them. So let me understand well the question. You cannot, even if you approach an investor, this investor will dilute all of you, okay? So if this is what you want, you can't get rid of them unless you talk with them and you agree with them that they have to, you agree that they have to dilute their portion if they accept. If they don't, well, if you're the one doing all the work, you can, you know, ask for additional management fees, you can take more money, etc. So I answered you a general answer. I'm not sure about the specifics, but you know, I had the opposite case. I had somebody who has put all the investment and he was doing nothing, and he had two other partners and they tried to get him out and to you know, get rid of him. And I helped him not to you know, be kicked out, because it's his right and he has shares in this company. Now, if they are toxic to you, well, it depends. The product you have, is it something you can move to another company? Is it something that bothers you? In my opinion, there's no better way than being honest with them and discuss everything on the table before you bring in an additional investor, because an additional investor is only going to complicate things. Okay. Okay, did I miss any question? I'm gonna stop the recording.